Thursday is one of the most important days this year for the European Central Bank. ECB President Mario Draghi is widely expected to announce a package of measures to extend or expand quantitative easing, the central bank's asset purchase programme. With me to discuss what the measures will look like and what they're likely to achieve is the FT's economics correspondent, Ferdinando Giugliano. Ferdy, what is the key aim? It's to get inflation higher in Eurozone, isn't it?
That's exactly it. So we can go to the first chart and we can see there that the red line, which is inflation, is way below where it should be. It should be just below 2%, and it's at 0.1%. So it's well below that level. Now, the ECB obviously has a mandate to bring it back to just below 2%, and that's what Draghi is trying to do.
And there's a lot of artificial nature about this, isn't
there?
Well,
there is some of it. As we see, core inflation, which excludes energy and other volatile items, is around 1%. So still below the target, but it's substantially above overall inflation. And why is that? It's because this 0.1%, a lot of it is down to the collapse in oil prices, which we've seen over the last year. Now, some would say that actually as we move into the new year, that effect will disappear. That's because the 12-month comparison, which is what inflation is based on, it's annual inflation, will no longer take into account prices which were before the big oil price slump. So that means that inflation in the new year is naturally going to go a little bit up. But I think the ECB and particularly Draghi are keen to ensure that really the Eurozone gets back to the inflation target, the Eurozone inflation gets there, and that the Eurozone recovery continues. And so he's probably going to take this window of opportunity in December to do more.
All right, so there's been a lot of talk in the lead up to Thursday about whether the ECB is going to cut deposit rates. Now this is as we see in our next chart, compared to other central banks, this is going to have a broader impact beyond. First of all, what do you think is the likelihood of that happening?
There's been a lot of speculation. There are a number of possibilities. One is, as you mentioned in your introduction, is tweaking the quantitative easing scheme. So the ECB is buying 60 billion of assets each month, and it's going to do it until September of next year. Market analysts think the ECB could make it bigger by more than 60 billion. Could expand it. Now, at the moment...
You mean the length of time?
Yeah, the length of time. At the moment, it's already said that they could go on if they wanted, but maybe market may like a little bit more reassurance on exactly how long it's going to go on for. Or they could actually just buy other kinds of assets, become more creative in their approach. So these are all the kind of QE option. The other option, which has to do with, in a way, it may sound strange, more conventional monetary policy, is acting on the deposit rate in particular. So this is the rate which banks receive when they park their money with the central bank. Now, it's already negative. The ECB may decide to cut it further down, which means that it's charging even more money to banks for the privilege of parking their money at the central bank.
And that's going to be a problem for the Swiss National
Bank.
Well,
that's going to be a problem for many other banks in Europe. And so now we know that in Switzerland, the deposit rate is already very, very low, minus 0.75%. Pushing it even lower, we start wondering, when do banks start charging customers for depositing their money?
And the pressure on the Swiss, we'll see in our third chart, is that if the euro keeps going lower as it's heading towards parity with the dollar, that's going to weigh on other currencies such as the Swissy, and that's going to drive the Swissy higher, which is a difficulty for them. But we're seeing a great strength in the Draghi policy of talking down the euro, and I suppose the market expectation is that Thursday is going to fulfill a lot of that, isn't it?
Well, I think that's right. There are analysts I've spoken to who already have the euro below parity with the dollar, which is amazing if you think about it. But in a way, he really hopes that this is going to do the trick in terms of boosting export. But also remember, this is crucial for inflation. If the euro goes down, then that means that the cost of imported goods from, say, the US, but also other countries, goes up. And since that counts, that is part of inflation, that should do a little bit of the trick to get inflation back on target.
Fergie, thank you very much indeed. So there we have it. We're going to see probably inflation grow, the euro fall, and it all feels like Mario Draghi is getting his way with the ECB policy.